out with a zero basis for the investment in the qualified opportunity fund. If you happen to hold it, the investment in the qualified opportunity fund for 5 years, and again, this is rewarding long-term investments, not get in, defer, and get out, but rather long-term. So 5 years, you get a 10% basis adjustment, eliminates effectively 10% of the deferred capital gain. If you hold it for 7 years, and that 7 years is prior to December 31, 2026. Now, again, that date is closing in because December 31, 2026 minus 7 years is December 31, 2018, which the day of this broadcast is November 18th, so that's not too far away. So if you happen to have 7 years, then you get an additional 5% basis step up, and you have 15% in total. And then, because the statute is rewarding very, very long-term investment, if you happen to hold the investment in the Qualified Opportunity Fund for 10 years, and then you have a subsequent disposition, any appreciation value completely avoids tax. It's completely excluded. Now, what can happen along the way in the estate planning world? So those are the key principles. Well, what happens in estate planning? You plan for when people die. So death is something that could occur, say prior to December 31, 2026, or some other date along the holding periods I just mentioned. Or you could say, well, I want to pass this perhaps to my children or my grandchildren or to a trust for their benefit. And I want to put this particular asset and put it in there, maybe by gift or maybe other transactions that we like to do in the estate planning world, which could involve, for example, sales to what's known as a grant or a trust that is designed to be outside of your estate for estate tax purposes, but for income tax purposes considered one and the same as you. And what do the rules say there, and are they consistent? Here's some of the concerns that I have, and we're probably going to unpack this a little bit more as you have further questions, Rakesh. But death, the statute says death is not going to be a realization event. And the proposed regulations that came out so that if death occurs, that's not going to be a triggering event for a premature inclusion of the income that's been deferred. So if someone were to establish a qualified opportunity fund, now they die, say, in 2023, at that point in time, that's not going to trigger the deferred gain. That deferred gain still would not be triggered until a subsequent disposition or an outside date of December 31, 2026. Well, that sounds fine and seems to make sense, but here's a concern that I have. Let's say the person who died in who basically invested in the Qualified Opportunity Fund here in 2019, latter days of 2019, dies in 2023 under the terms of his will. Let's say he's given the interest in the Qualified Opportunity Fund to his favorite nephew, but he doesn't give anything else to his favorite nephew, such as cash. Come December 31, 2026, that nephew will have to pay tax on the deferred gain. Now, there is a benevolent rule that's built in here that says that if the value of the Qualified Opportunity Fund has gone down, you are capped and you only pay tax based upon the lower of the fair market value at the time of the realization event, December 31, 2026, or the amount of the deferred gain. So you at least get that benefit, but there still is a tax liability that's due, and the concern is that the favorite nephew in this particular case won't have the cash to pay it. The Treasury is not going to accept an interest in a qualified opportunity fund that very likely is going to be highly illiquid, quite possibly without a secondary market having developed for it, and who knows whether or not there would be redemption privileges in the fund. So that's a concern there, and that's a fairness concern which we addressed in our comment letter, and which I addressed my comments to Treasury at the public hearing in July of this year, 2019. And the solution we came up with was, let's allow a little bit more flexibility, perhaps, to that poor nephew in that situation, so they don't basically have to have a fire sale their interest or borrow very heavily, and there might not even be a means to borrow to come up with the tax. Let's have some sort of deferred payment mechanism built in, because that seems to be consistent with the whole purpose of the rules, and not to basically club or punish someone who happened to inherit an interest. The response received from the folks at Treasury, and again, we'll see what happens when the final regulations come out. They've been been represented as being likely to come out by the end of this year.
Hmm.
We shall see, but that is a current intelligence by the end of this year of 2019. But some of the responses from the panel of Treasury was, well, what if we had an installment payment plan? Would that make sense? And my response to that was, yes, that would be very, very helpful. So we'll see how that turns out. Now, we talked about death. What else could happen in the estate planning realm? And where are some fairness concerns? Well, I talked about the statute. The statute says two triggers for income inclusion. You could either sell the interest in qualified opportunity fund, or you could have a happening of December 31, 2026. Sale or happening of December 31, 2026. Nothing else. What about a gift? Well, I would think that if you were to make a gift, and the answer is this is not what the proposed regs say. Very important. Okay. But what seems to make sense based upon the statute is that as long as you have a gift and you don't have debt encumbering the property gifted, that's the nexus of basis, that should not be a realization event. Unfortunately, the proposed regulations take a contrary view. And they don't do it based upon the statute because there's language in the preamble of proposed regulations, and this is the second tranche proposed regulations that came out in April of this past year, 2019. They say we recognize the statute doesn't say anything about it. The statute only talks about two triggering events: death or the happening of December 31, 2026. But what the preamble said was if you look at the congressional record, it suggested that any diminution in the holdings of the investor, of the qualified investor who has the interest in the qualified opportunity fund, unless it's a transfer to a grant or a trust, that's going to be treated as a realization event. Taking a look, parsing through the congressional record, it doesn't say that. I'm tempted to say it doesn't really say it, but it goes beyond that. It just doesn't say that. So part of our comment letter and part of the testimony I provided at Treasury was very respectfully, this is an unsupported position. I understand the policy. You want to make sure that someone pays tax. We could basically have something very similar to the death situation, where whoever is a donee perhaps pays tax come December 31, 2026, or upon an earlier disposition. So those are some. It took a little while for me to unpack this, but those are some fairness concerns that we've spotted here that we've thought warranted to be addressed.
Right. So thank you, Kevin. You addressed the issue of death, you addressed the issue of gift, and then also the transaction with grantor trust. Am I right in terms of capturing these three things? And then two other events. What happens if the value of your investment drops before 2026, and the nephew has this gift, but it's not worth $1 million, it's worth maybe $500,000? What would be the repercussions to the nephew? Number one question. And number two is that, can the nephew finance this investment and get some money out of it? I mean, we're just focused on real estate for now, but then the same question could be asked about a business which may or may not have liquidity.
Yeah, well, absolutely. And this, by the way, does apply to operating businesses. The second tranche proposed regulations go in depth as far as how you could have an operating business and what standards are needed. You have to have 50% income derived from the opportunity zone, and you could meet that through a number of safe harbors or facts and circumstances test. And the safe harbors, among other things, look to see compensation of employees and independent contractors, and either based on hours or based on amount of compensation, whether or not that's in the zone. There are other aspects too, but very importantly, the second tranche proposed regulations expanded the scope here to provide a roadmap for operating businesses. But regarding gifts, well, what the rules say is very interesting. So again, a gift under the proposed regulations, unless it happens to be a grant or trust, and there's a carve out for the grant or trust, because a grant or trust under the tax rules, even though it's designed to be a completed gift for gift tax purposes, and if you die outside of your estate for estate tax purposes, for income tax purposes, it's like it never left you. It's as though it went from your right pocket to a left pocket. There's a revenue ruling 85-13 that says that, and that analysis that's in the proposed regulations is consistent with that. So if you have a gift to a grant or trust, it's nothing to worry about. What if you however, have a gift and it's not to a grant or trust? See, that's where the concern arises, as I mentioned previously, because that is currently, under the proposed regulations, the second tranche, treat it as though it were a sale, even though it isn't a sale. And again, the statute doesn't seem to support it. And our comment letter through ACTEC mentioned that, and also traced very carefully, as I mentioned before, through the legislative history, which also doesn't seem to support it. But right now, that would be a realization event. That realization event probably would be based upon the fair market value at the time. So if there's been a reduction in value, then it would be that reduced value at time less any basis adjustments. That would be the amount of the inclusion. If the amount has gone up, well, there's a cap there, and that cap is based upon the deferred gain amount. So you're never going to have to pay more. So it's going to be capped at the amount of deferred gain, but at least there is that beneficial rule that says that if you have a disposition, the fair market value at the time of disposition is going to be is in general going to be the outermost boundary of what's going to be determined to be the amount of the inclusion event.
That's a good point, Kevin. Now, but what about the financing? Can the nephew raise money, or does he? I mean, what kind of provision do they need to make in their gift so that the nephew can at least raise some funds from an outside party and pay the taxes?
Well, right now, the statute and also the regs doesn't provide any help, which means that it all comes down to self-help on the part of the donor and on the part of the uncle who wants to leave the interest and qualified opportunity fund to his or her nephew, either during lifetime, say by gift, and let's say it's outright and not to a grant or trust, so that this way it's a triggering event, at least under the second tranche proposed regulations, or at death. So you always have to think in terms of financing. Now, how death is a little bit easier to think in terms of, because what are some of the techniques we typically use for financing? We use life insurance, and anytime we're thinking about estate tax exposure, we always want it to be in a properly crafted and drafted estate, very effectively estate tax proof, irrevocable life insurance trust. The one concern there is that you need to make sure that the trustee or the trust who gets it, who would get the proceeds of the life insurance policy upon death, also is the holder of the interest in qualified opportunity fund. Because if it goes to someone, or at least is a trustee of a trust in which a nephew is a beneficiary. Because if that's not the case, then you'd have to say, well, as a fiduciary, as a trustee, can the trustee loan funds to this nephew who's not a beneficiary of the trust in order to help fund the payment of the inclusion amount? So that becomes a quandary, could be avoided if you plan and say that, okay, I will either one way or another establish a side fund. It could be through an irrevocable life insurance trust, and maybe make the primary beneficiary of that irrevocable life insurance trust a nephew, and that would allow for the funds to be, the proceeds of life insurance to be delivered. If, however, there isn't death occurring, it's a lifetime gift, and again, let's say under the second tranche proposed regulations, and let's say it's not to a grant or trust, then what the donor has to think is, well, in that particular case, bear in mind that the tax is being imposed upon the donor, not the donee. So you don't have to worry about providing a source of funding to the nephew here, because the tax is going to be imposed, the inclusion event is going to be upon the donor, but the donor has to be mindful of that. The donor, all along has been able to defer tax, so hopefully some sort of side fund has been established, almost like a sinking fund, very unofficial, but just saying we need to keep funds available to pay the taxes that become due upon a realization event. Again, gifting could be a realization event, at least under the second tranche proposed regulations.
I got it. Thanks, Kevin. Now we have a quick question in this regard, which I might ask. And by the way, for all those who are listening to this webinar, there are two handouts, which basically are the documents that Kevin submitted to the Treasury. They're very informative, so I would encourage you to download them. Now, the question, Kevin, is that those who inherit, and if they leave the investment in 10 years, assuming they have the money to pay in 2026, do they get the benefit of the elimination upon the sale of that asset after 10 years?
Oh, the appreciation. The answer is yes. So there's a different holding period that applies It's a 10-year holding period for the to exclude the appreciation. Now, the question is, what could happen in a death context or also a gift to a grant or trust context? In the case of death, the proposed regulations are clear that there is a tacking of the holding period, so that if rich uncle dies, leaves the interest in the qualified opportunity fund to the nephew has the tax hit come December 31, 2026, at least under the current status of proposed regulations. But let's say the nephew pays the tax or has funding for the tax. Again, perhaps it's through an irrevocable life insurance trust. And let's say the value of the investment, the qualified opportunity fund, takes off. And let's say that it appreciates, let's say it doubles or triples from the amount. All that excess appreciation, once 10 years has elapsed from the initial investment in the fund, the initial investment in the qualified opportunity fund, with tacking applying in the case of death, and the proposed regulations, second tranche proposed regulations, is clear that in that case the nephew would get the benefit of the exclusion. So that's significant to bear in mind. In the case of a gift, well, again, the gift is going to be an inclusion event. And let's say it's not a gift to a grant or trust, and then we'll hit gift to grant or trust in a second. So if it's an outright gift under the second tranche proposed regulations, that will be an inclusion event to the donor. That will change the taxpayer, which presumably means that there would not be a tacking of holding period as far as the nephew is concerned, who received the lifetime gift where it's not to a grant or trust. That rule doesn't sound right. But that seems to be the current state of affairs under the second tranche proposed regulations. Now, if instead the gift is to a grant or trust, again, proposed regulations say that because that's treated as one and the same taxpayer, a donor, as a donor, it hasn't changed taxpayer for income tax purposes, although it may be a completed gift for gift tax purposes and designed to be outside the donor's estate for estate tax purposes. That is not going to have any effect upon the holding period. That should produce tacking. And I say should produce tacking because the rules there aren't 100% clear. We want a little bit more guidance in certain contexts. In the case of a gift, it should work. But one area that wasn't so clear in the case of transaction to grant or trust is there's a lot more you can do besides gift assets to a grant or trust. Because it's considered a tax nothing for income tax purposes, quite often you will sell assets to a grant or trust. Sometimes you'll have, as a grant or trust trigger, the ability to swap assets in and out, pull assets in and out. Sometimes there are payments. If you have a special type of trust called a grantor retainer annuity trust, you could have payments in kind that go back and forth. How is that treated? It's not so clear. I would think that the rule, as it ultimately comes out, will be that if you have a grant or a trust, you look at the starting period of when the donor made the initial transaction with a grant or trust, be it a gift, sale, or otherwise, and that it starts the clock for the 10-year period. However, again, that isn't yet 100% crystal clear. Hopefully, and we've requested guidance on this in our comment letter. And hopefully we'll get such guidance in the final regulations, which hopefully will come out later this year.
That was very helpful, Kevin. Thank you so much. Now, interestingly, besides all the other comments that you made, which were very, very significant, you also asked Treasury to extend the 180 days period for two things. One is the K1, if the K1 is delayed, and also for the beneficiary of the estates and trust. Can you just explain that to us as to what does your rationale behind it, and how do you think it's going to pan out in the final regulations?
Well, that's an interesting point from the point of view that the goal of the legislation here is to encourage investment in economically distressed communities. And I know that there are proposals, there are concerns for transparency, there are concerns about adjacent tracts and the like. All that does need to be addressed, but that is part of the tweaks that is part of the legislative process and the regulatory process to have a statute that is designed to produce the level of social impact that this statute is designed to produce. But regarding K1s and the like, let's say you have someone who wants to take their capital gain and invest in the Qualified Opportunity Fund. They have to do that within 180 days of the relevant period. Now, if they have an interest in a partnership The same rules apply for S corporations and also beneficiaries of estates and trusts. There's a special rule that says, for the most part, unless an election is made otherwise, the 180-day period doesn't begin until the end of the tax year, which is very helpful because there could be a sale, say, by a LLC taxed as a partnership or an S corporation that occurs, say, in February, and 180 days from that is going to be August, but it's treated as not occurring until December 31. Very, very helpful. So there already is precedent for Treasury taking a liberal view on the rules to be helpful to taxpayers to achieve the goals of the legislation, which is to promote investment in these economically distressed communities, to these opportunity zones through the vehicle, the Qualified Opportunity Fund. Again, it has to go into the Qualified Opportunity Fund. So we have this precedent here, but what could go wrong? How could this become unhinged along the way? Well, let's say you have an LLC taxed as a partnership. It goes on extension for the tax return. So instead of filing in April, let's say it files in August or September, which is into the second half of the year, way more than 180 days. And only at that point does it issue the K-1 to the investor, who then says, wow, I have a gain from last year. I've got an extension myself because I didn't receive the K-1 until just now from this LLC or limited partnership or S corporation, or it could be an estate or trust, and I'd like to defer the gain and invest in the Qualified Opportunity Fund. However, if it's more than 180 days in the year when you receive the K-1, you're totally out of luck. You have no chance to address that, and that's very problematic. So our solution here was, well, one way to possibly address it would be perhaps adopt a liberal rule along the lines of the extension December 31st that I mentioned previously. If you have a partnership or S corporation or estate or trust where an actual sale is made early in the year and an election is not made to the contrary, to say that perhaps 180 days should run from the later of the deemed end of the year, December 31, say 2019, just to put a date out there, or if later, 180 days after the timely filing, including extensions of the entity's tax return. That would seem to make sense. Now, again, that is not the current state of the proposed regulations. It does not say that. But again, thinking in terms of the goals of the legislation and what Congress has been trying to do, and bearing in mind, again, this is a bipartisan effort, and that's something very important to bear in mind when one looks at prognosticating, just for down the road and the like. I think that would be very, very helpful.
Yeah, Kevin, thank you so much. Our time is up, and I'm going to hand it back to Tom and Dave. But one last question. When do you expect the Treasury to give us the final guideline? Your guess.
Okay, let me take out the crystal ball. Hold it a second. It says, no, unfortunately, it's not. It's a little bit cloudy. What has been said, including by David Carter, the Assistant Secretary of Treasury, last week, is that it could be, quote unquote, could be by the end of the year.
Awesome.
Could be.
Thank you.
Not that it will be, but could be. So stay tuned. Hopefully by the end of the year, hopefully before I'm going to be part of a panel addressing this at the Heckerling Institute in Orlando in January. So hopefully it comes out before then and sufficiently in advance of then so I can digest everything beforehand.
Right, Kevin, I appreciate if you could keep us posted about your upcoming presentation like this heckling. I will encourage our audience to go and listen to you either on a webinar or live in somewhere. So thank you very much, Kevin. Back to Dave.
Rakesh, thank you so much. Thanks for everything today and throughout the series. And Kevin, thank you so much for joining us today. Just wanted to remind everyone, our next webinar in this series is on December 2nd. That's 2 weeks from today. Taxation and related concerns for investing in opportunity zones with Rakesh Bhargava and attorney Matthew E. Rappaport. And that will be a CP webinar, and so will the last one on December 16th. So we look forward to seeing you 2 weeks from now. And please join us again on that date. Thanks again for your time today.